Hi everyone, it's Clinton. We're going to get started here in about 2 minutes. We're just waiting for everyone to come online. So I'm going to put everyone on hold and we're going to allow some more people to log on, and then we will get started in about 2 minutes. Hi everyone, it's Clinton. We're going to get rolling here. I am going to start my screen. So just a few little housekeeping issues. If you want to ask a question, there is an area where you can pose a question in the GoToWebinar portal. So you can certainly ask any questions there. And I hope that we can answer as many questions for you, and it's going to be an informative half hour. So I want to thank everyone for joining us here today. I know the world has changed a little bit recently, and I think things like this GoToWebinar are even more important than they ever have been. So hopefully lots of good information. So today we're going to be talking about credit, and I will just get our screen up here. So just a little bit about me. I've been a mortgage broker in Halifax for over a decade. I've actually been a mortgage broker for 14 years. I've been in the office that we're in now for about 11 years, and we have opened over 10,000 files. So I've literally seen everything. And nothing surprises me anymore. And one of the major cornerstones of mortgage lending is really around that credit piece. So credit is so important. And it's not everything, but it certainly is a major piece. And the better the credit, the better terms you're technically going to get. And some people have great credit and they want to know how to maintain it. And I'm sure there's some people that are on the webinar that are looking to build their credit and maintain it. So we can certainly talk about all kinds of different options. And credit really is a snapshot in time. So, if you've had some challenges in the past, it will certainly get better. anything that's on there is going to, fall off within six years. So we'll go through all that stuff as well. So the reason that I opened our mortgage team here is to really help customers. And I think the financial well-being is so important. And home ownership is part of the Canadian dream. And credit is really one of those major cornerstones. So we have a little bit of a quote here, and it's really about understanding your credit report and being able to properly navigate the report is essential. And that's really why we're here. This becomes a large part of being able to borrow money from a lender. So, knowing what is on your credit, I think is so important. And it really empowers you. So the topics that we're going to go over today are what exactly is a credit score and what is your score? What is a good score? What score is needed for a mortgage? How can I keep track of my credit score? What are the best ways to improve my score? What are the different types of credit? Which one is best? How can a mortgage broker help with my credit score? And is there anything else that you need to know about credit? Everybody's situation is different, and we're going to go over a lot of the cornerstone points here. So what exactly is your credit score? It's a tool really to be able to manage your credit. And it's a tool that lenders look at evaluating, your worthiness to be able to borrow money. Your credit score keeps track of behavior around your different type of credit accounts. It helps lenders determine what we consider credit worthiness. And what is a good score? And I think everybody's credit looks a little bit different. The score is out of a maximum of 900. Typically what we say is anything over 720 is considered stellar. And majority of normal bank lenders want to see a score of at least 680. Now that doesn't mean that you wouldn't get approved if you had a score below 680 or 720. Typically the minimum score that's required for an A lender is 600. But if your score is in the lower 600s, there's really going to need to be an explanation about why that score was low. Was it previous missed payments from health issues, marital breakdown, loss of business, COVID-19? I'm not sure. Or is it more around utilization? Maybe you have a credit card and you have a high limit or an over limit, and that's bringing down your score. Some of these things can be fixed really quickly, and some of them, obviously, you need to wait out. So like what I said, if you've had a bad account, it will come off after 6 years of the date of the last activity. And that's kind of the rule of thumb. The most important part of credit, I think, in general, is about building the history and managing it responsibly. For a mortgage, what do we look for? Credit's just really one piece of the puzzle. We're really looking at income and we're looking at assets as well. And the credit really can determine what type of down payment you need. Obviously, the stronger the credit, maybe the smaller the down payment. And if you've had issues with credit in the past and you're rebuilding, it doesn't mean that you can't get a mortgage. Every single borrower in Canada can get a mortgage, but maybe the terms just won't be as great if the credit's been damaged or is in the rebuilding phase. So typically 650, but scores of 720 or higher would pretty much get the best type of situation, the best type of rate. How can you keep track of your credit? So I really love telling consumers to keep an eye on their TransUnion and their Equifax by downloading apps of Borrowell and Credit Karma. Those are typically the best way that you can keep track of it, and it's free. If you don't mind paying for your credit monitoring, you can actually sign up on Equifax and TransUnion directly, and they offer a credit monitoring tool. You'll get the same information from Borrowell and Credit Karma, but the ones directly on the credit agencies would have the most amount of data for you. There's pros and cons to both. Obviously, if you take Borrowell and Credit Karma, for example, it's free. It may not be as in-depth as going directly to one of the credit bureaus. And I think if there is something that's wrong on your bureau and you want to get it fixed, we can certainly help with Equifax through our commercial account. But TransUnion, you need to fix it with them. And it's best to order an investigation form directly from the credit reporting agency, because they're the ones that are at the end of the day going to fix it. And they're the ones that are going to contact any creditors that are reporting something incorrectly. How can you improve your credit score? Well, credit is really made up of multiple different pieces, and it basically changes over time. It's an algorithm. And I think there's a misconception out there that credit really is driven down by inquiries. Inquiries are really only 10% of the actual score. The bulk of the score is really determined by your repayment history. So about 33% or 30% is repayment. Another big chunk is really around utilization of revolving credit. So for example, if you have a credit card that has a $5,000 limit, it's best to keep the balance below 50%. So that would be a balance of $2,500. And a little kind of trick that I love is if you're looking to boost your credit score quickly, pay down your revolving accounts before the statement generates. Whatever balance shows on your statement is what's going to show on your credit bureau. And some people call me and we go over their bureau and I say, okay, you owe $7,000 on this credit card. They're like, oh no, I owe $3,000. I paid it down yesterday. Well, it doesn't reflect instantly. It only reflects as per your last statement. So knowing your statement cutoff dates is so important. And if you're really wanting to boost your score quickly, pay it down a couple business days before the statement generates, and then whatever balance shows on the statement is what's going to be reflected on the bureau. It takes about 5 business days to update. Some obviously update faster than others, but that's a good rule of thumb. Also, get your bills paid on time. Credit cards, of course. I like automatic payments. I think they really work very well. Get your cell phone account set up to come as an automatic payment off your credit card. You know, majority of late payments that I see are usually on cell phone accounts and they're on student loans. Oftentimes when you're on interest relief for a student loan, it actually reports as a late payment. I find student loans are the #1 challenge sometimes on a credit bureau, but also people are not that great at paying their cell phone accounts. I'm not sure. I think it's because the bill is, you know, fluctuates based on usage. But if you have that coming off of a credit card every month automatically, it's going to guarantee that it's paid. And then of course you can fight with the, you know, cell phone company after if there is a problem. But really paying your bills on time is so important because a late payment will stick with you for 6 years. But also using your credit. Sometimes having no credit is bad as having bad credit. So if you have a credit card and you're never using it and you're keeping it always as a 0 balance and it's reporting that credit bureau with a 0 balance, it can actually fall off if it hasn't been used in 6 years, even though you may have an open account. And having no credit is just as bad. So you should really use your credit cards, use them and pay them, use them and pay them. But when the statement generates, ensure that it doesn't generate with a balance above 50%. And use the bank's money for free. Typically, you have about 30 days after the statement generates to make the payment and then pay it off in full. Then you're not paying any interest. And different types of credit. Not all types of credit are made equal. You know, there's credit cards, there's lines of credit, there's student loans, there's installment loans. And the perfect credit is a good mix of everything. So typically what we tell people, it's the rule of 2, 2, 2. 2 pieces of credit for a minimum of 2 years with a high limit of at least $2,000. That's how you can make the perfect score. Use it and pay it, make sure it's always paid on time, keep your inquiries to a minimum, and a higher limit is better. High limits and low balances will definitely give you ideally the best score. If you have all credit cards, that's going to drive your score down. If you have all installment loans, that's going to drive your score down. And the types of credit certainly can drive the score down as well. If all your creditors are Citi Financial, Desjardins, Wells Fargo type lenders versus credit unions, banks, major credit card companies, that the mix is going to hurt you as well. So I think having that perfect mix is great. A credit score out of 900 and a score of 900 is really a unicorn. I don't know if you guys have seen a unicorn before, but I haven't. But there's lots of borrowers who have scores in the 800s, which is wonderful. And having a score of 820 or a score of 720 to us really makes the same difference. It really has no impact on your credit worthiness. But it's not all about score. It's really sometimes about how thick your credit is, how long you've had credit history. And sometimes we see false positives and sometimes we see false negatives. And that's why it's not all about the score. But obviously, if the score is low, there needs to be a good rationale about why, and obviously a plan to get that score back up. And how can a mortgage broker help with your score? You think a score is a score is a score. It's not going to change. The score is really a snapshot in time. But where we're an unbiased mortgage professional, we don't care what lender we're going to lend you money. We don't get paid unless we get you an approval. So we're motivated to help you. And I think the first step is, if you're looking to buy a home, is start with a pre-approval. Know what your score is. And oftentimes, many Canadians think they have great credit, but maybe there's something on there that's not correct. Or maybe there's a slight change you can do to really boost your score. And sometimes you can change that score within 30, 60, 90 days. And sometimes that's all it takes in terms of making a plan. Now, some borrowers, obviously, it takes longer. And I've thrown this out a few times, 6 years. 6 years is the date where bad things fall off. But that's 6 years from today. Maybe you had some delinquency 3 years ago, and maybe you only have to wait 3 years for that item to fall off. And sometimes it might be more recent, and maybe you want to transact right away. And sometimes we can say, okay, you either need to settle or pay this debt, and we can help you get that updated on your credit bureau. So I think it's really going through that process and really looking at what you owe and really what each trade line looks like. I'm just going to pause here just for one question. I have a question here in our GoToWebinar technology. And if anybody else has a question, feel free to put them on there as well. We still have a few more slides to go through, but we still have about 12 or 13 minutes. So do you need to track both Equifax and TransUnion? I think that's a great question. Thanks for asking. The scores can be different on both. And sometimes there can be good information on some and bad information on the other, and vice versa. They both work independently. They should have the same information, but they oftentimes don't. So I would definitely track both of them, especially if you're looking at doing a purchase, a refinance, or a renewal. You should know what's on both credit bureaus. Typically, TransUnion, the data stays on longer for good accounts. So if you had accounts that have been on there longer, any good accounts will stay on forever. It's only the bad accounts that will fall off after 6 years. So if you even have credit that you opened, you paid it off, and you've closed it, it'll stay on TransUnion for life as long as there weren't any derogatory credit pieces. So we have another question. Could you do a quick review of the mix of credit? Okay, this is a good point. So revolving installment mix. Ideally, the ideal type of credit would be a car loan or a lease. So that would be considered installment, and then having a revolving credit card and or line of credit, which would be revolving. The age of the car loan, obviously, if the age of the car loan could be over 2 years, that's ideal, because obviously newer loans don't show as much history. Same thing with the credit card. You want to have the credit card for a minimum of 2 years. And the limit on the credit card should be at least $2,000. That's the ideal. Now, not everyone can get approved for a $2,000 credit card, and that's okay. Some lenders will start you with $300, $500, $1,000. Use it and pay it. And if you pay on time, typically what happens the lender will increase your credit score. So if you have any other questions, feel free to certainly ask them, and we'll continue along, guys. Anything else you need to know? So now we've covered quite a bit. We've answered a couple questions here. I really think what everyone should do once you get off this webinar, if you don't have it already, download Credit Karma, download Borrowwell, get those apps set up, and they'll update you on a monthly basis on what's going on. If you have great credit, perfect, download it, make sure everything's good, continue what you're doing. If you're building credit or reestablishing credit, then I think you should do the exact same thing. And, you know, really, I just want to really drive it home that the credit score is a snapshot in time. It's not a forever thing. It could be impacted in 1 month, 1 year, 6 years. We have another question, guys. I've heard that the percentage of usage should be below 30%. Is that per card or per line of credit or total credit? Great point. If you have one credit facility that's over limit and then another credit facility that's zero, that's going to drive your score down. Ideally, we want to have the utilization pretty even, ideally, but they will score high utilization on a line of credit with less damage than it would be on a credit card. So the types of credit that you have utilized and the percentage of the utilization is not going to be as bad on a line of credit as it would be on a credit card. So if you have 5 credit cards all maxed out and a line of credit with no utilization, that's not really going to work so well. So I would really work on the balance, but what I would do is I'd have the balance of the debt mostly on a line of credit. That would be ideal, because obviously you want to have it on your lowest interest facility to be able to pay it down as quickly as possible. Now, we said that everyone can become a homeowner. Everyone can be approved. So, you know, if you have good credit, you can get a down payment with as little as 5%. You could also qualify for the first-time homebuyers incentive, which we can certainly talk about offline. Nova Scotia has a down payment assistance program, and there also are lenders who will do a cash back in terms of a zero down payment. So those are for borrowers that have great credit. If your credit's not so great, you probably can still get a mortgage. You know, we can work with you, and maybe you can still get a mortgage with a lower down payment of 5% or 10%, or maybe you need a cosigner. But if you've really had some damaged credit and it's not quite repaired to where it needs to be, borrowers can still buy a home, they can still get a mortgage, but typically they need to have a larger down payment. And depending on how severely the credit is damaged, maybe you need 20, 25, 35% as a down payment. And everybody's situation is a case-by-case basis. And we don't have, you know, a one size fits all solution. And that's why I think it's so interesting. And as I said before, credit's only one of the pieces. So obviously if the credit's not as strong, hopefully the income's strong and you have great assets, or vice versa. If you don't have great assets, you should have really great credit. Now we have some other questions that you guys submitted up front. So let's go through some of these. And if you think of any other questions, certainly put them in the GoToWebinar and we will jump on and answer those. So we have 4 questions that were submitted up front and we'll go through these. And if you submitted any other questions, I do apologize that we didn't get them all on here. So you can certainly reach out to us and I'll put my contact information at the end of the slide presentation. So here are some questions that you guys submitted. Is it better to pay back debts or save money first? I think that's a bit of a balance, guys. You know, for me, I think it's all about paying yourself first. I pay down the debt because if you're paying a lot of interest, it's going to take longer to pay that debt down. But if you only have a small amount of debt and you're really looking to move forward quickly and you need to save for the down payment, I think it's a bit of a balance. And I think everybody's situation is different. So I think it's a balance between what you owe and what you're saving. But if anything, I would pay your debt down first before you save. Okay, let's get the rest of the questions up here. Next, how long does a consumer proposal affect getting a mortgage? It's the same thing really as a bankruptcy. Typically, you need to be discharged for 2 years with 2 years of reestablished credit after the discharge with 2 new items, minimum $2,000. So let's call it the 222 rule. Same for consumer proposal as it is for a bankruptcy. Generally, what is the best thing a prospective homebuyer could do to improve their credit? Make sure you're paying your bills on time. Get your credit card on, or sorry, your cell phone onto a credit card for an automatic payment, and bring the balances down on the revolving debt. Honestly, within 1, 2, 3 months, it can make a huge difference to your score. And I would really start with pre-approval and see where you're at, because maybe it'll be a little surprise and delight. I would still do the Credit Karma and the Borrow Well. Next question. If I have a credit card with a small limit and a large limit, should I only use the one with a large limit? I would say yes. High limit, low balance, ideal. If you have a small limit and you even have a small balance, sometimes that can be over that percentage and really drive your score down. So I would definitely use the one with the higher limit if I were you. All right. Do we have any other questions? Let's just look. I see another one here. What is involved in a pre-approval? I think that's a great question. We certainly look at your income, we look at your assets, and we look at your credit. That's an individual thing. There is a link on our website where you can do an online application, or we can certainly set up a time to take an application from you over the phone, and we can go over all of those things with you and make a plan. To be clear, is utilization, the utilization is decided per credit facility individually? Yes. So each piece of the credit is how the overall utilization is calculated. Let's see if we have any other questions. Oh, here's a good one. Should you use both? Because to keep a card at zero balance is not good for the credit, I believe you just said. That's, if you have one card at zero, no big deal. But as long as you're using one revolving piece, that's all good. So you could have multiple credit cards, but if you're only using one, that's fine, as long as you keep the utilization to a minimum. So I have another question here. How do married couples scores affect each other? Are the scores completely independent? How can they affect the mortgage? Great question. They are each individual, but if you have any joint debt, the joint debt would obviously be reported on both bureaus. If one person has good credit and one person has bad credit, sometimes what happens is the lender will only allow one borrower on the mortgage and on the title. So I think that's certainly something that would be looked at for a pre-approval. And we see that all the time. Typically one spouse could have good credit, one could have bad, and we look at that. Sometimes we can help the one with not so great credit improve it and have them both on there, or sometimes they will allow the spouse with negative credit to be on the application and the mortgage and the title, but maybe they'll make us zero out their income and still make sure all the bad debts have been settled prior. So that's kind of a case-by-case basis. Could you address that if you're a secondary card and no other way to establish credit, you could lose points? So a secondary card, if it's joint, it will report to your credit bureau. If it's just a secondary card, then that's no good. That won't impact you at all. It would only impact the primary borrower. Just gonna see if I can see, I think there's another question. Somebody just wrote that they lost a ton of credit by being a secondary on my husband's card. So if you are joint and that card isn't managed properly, that could definitely impact your credit. Let's just see if there's anything else. I think that's all the questions, guys. So if you have any other questions, certainly get in touch with us. I hope we covered tons and tons of information. I know it's hard, but we are running short on time. I'm sure most of you are on your lunch break, whether you're at work or at home. So I'm certainly willing to answer questions about credit. I'm willing to answer questions on any pre-approval. Certainly reach out to us. I'm going to put all our information here on the screen, so you can feel free to take a picture of it You can visit us at teamclinton.ca and certainly reach out to us on email or give us a call. And if you want to take a screen grab or a picture of the screen, that's fine. I know some of you are already our clients, and hopefully the rest of you we can help in the near future. So if you certainly have any questions, reach out. It looks like the sun's coming out here in Dartmouth. So it looks like a great day, and typically we're very busy in spring. I can tell you that we've been very busy even with everything that's going on with COVID. Lots of transactions are still happening every day, so we can certainly love to help. So I want to thank everyone for watching. Happy Wednesday. And if you have any other questions, certainly give us a call. All right, thanks guys. Have a good day.